Welcome to our second video from topic 5, which deals with using Excel for the time value of money. We're going to be looking at, in the second half of this video lecture, on a little more complex uses of time value of money and how we can use Excel to solve for these calculations. Let's take a look at determining the payment amount. Now, this is something that obviously is useful both in accounting classes and in life. So let's say we are looking at purchasing a new car, and the dealer tells us that they can provide financing at, interest rates are low, so let's say at 4%. Right, so let's format that as a percentage. And these are going to be monthly payments, so they're going to be 12 payments per year. To figure out the payment amount, we have to know the periodic interest rate. And the periodic interest rate is our annual rate of interest divided by the number of payments within a period. Since we're talking about monthly payments, we're talking about 12 payments per year. And again, all interest rates, when they're quoted, are quoted on an annual basis. So here is our periodic interest rate. It's less than 1%. It's 0.3%. We'll leave that unformatted. Next, we can take out the loan for a maximum of 5 years. So they're 5-year loan, and we have to make 12 payments per year. So there'll be 60 payments altogether. And let's say the vehicle that we're purchasing is going to cost us $22,000. And again, we can format that for dollars. Now we can use an Excel formula to determine the amount of the monthly payment that we're going to make. So we're going to go up to Financial, and we're going to choose the PMT formula. And this calculates the payment for a loan. Again, we have our interest rate, periodic interest rate that we're going to use, and our loan amount, and this is going to give us the equal payments that we're going to use. The first thing Excel is going to ask us for is the rate. Now be careful here, do not use the annual rate. Instead, you're going to use the periodic rate. Next, it needs to know the total number of payments. So again, do not use the payments per year. Instead, use the total number of payments. And the price of the vehicle that we're paying, $22,000, is our present value. Let's say our loan will begin at the end of the month. Our first payment will be due at the end of the month that we purchased the vehicle. That will make it an ordinary annuity, and we'll leave the type either as a blank, or we can enter a 0. If payment had been required on the first day, which is often the case with a lease, we would put that down as a type 1. So we click OK, and the payment comes back as a negative number. Don't worry about that. That signifies that this is a cash outflow. You'll have to make a payment, so the cash outflow will be $405.16. We could also use Excel to determine the annual interest rate. So let's look at an example. Instead of this being the purchase of a vehicle, we are going to lease a vehicle. And we have done our homework, and we know the price of the vehicle we want to solve for the annual interest rate that is built into the lease. All leases have a built-in interest rate. So let's say we are told by the dealer that we can lease the vehicle for $450 per month. So again, we can format that to dollars. The lease is going to be for 5 years, and these lease payments are monthly, so we have 60 lease payments. And we know that the value of the vehicle is $22,000. Again, we can format that for dollars. Now we can use the Excel function under financial for interest rate. Excuse me, I misspoke. The function that we're going to use isn't for the interest rate. That is for an investment. We could use it, but it is not as clear as using rate. And this returns the interest rate for a period for a loan or investment such as this lease. All right, so we're going to put in our data. We have 60 payments. The payment amount is $450. Oops. Payment amount is $450. The present value amount is our $22,000. So our data inputs are our number of payments, the payment amount, and the present value, which is the selling price of the vehicle. We have a ordinary annuity. Well, let's say that we're going to make the payment on the first day when we leave the dealership. So we'll enter a 1 here for annuity due. All right, when we click OK, and you'll notice that we're coming up with an error. So let's explore and see what I did incorrectly. Well, Excel needs to know whether the payment amount is an inflow or an outflow. And in this case, since we'll be making the payments, I should have coded the payment as a minus number. Now that I've done that, you'll see that it returns an interest rate of less than 1%. Remember, that's the periodic rate, in effect, the monthly rate, since the number of payments is based on a monthly schedule. So to figure out the actual annual rate, we'll put in the number of payments per year, and we'll take the periodic rate and then multiply it by the number of payments. And we'll get an interest rate of a little less than 9%, 8.7%. So even though these payment amounts appear to be close, notice there's a much higher rate of interest when we use a lease versus a buy. Now, often we have a situation where our cash flows are not going to be equal. So let's take a look at a situation where we have varying cash flows. Let's say we have $200 in period 1, $300 in period 2, $100 in period 3, $300, $200. And these are all cash inflows, so we're designating them as a positive amount. Now, there's a couple of different ways we can do it, but the quickest, most efficient way is to use an Excel formula known as NPV, or net present value. This returns a present value where we have unequal cash flows. So this is not an annuity. We can use the NPV to calculate present value. As in all present value calculations, we need to know the interest rate. Here we're going to be using an annual interest rate. These are yearly amounts. So our rate we're going to use is 10%. Next we have to input the values. We can do these individually, or since we have the cash flows mapped out, we can highlight the range, and when we click OK, we get back the present value of this uneven cash flow at a 10% rate of return. Now in managerial accounting, we're going to be looking at capital budgeting, which looks at the return on an investment. And one of the techniques that is used is called the net present value technique. And it also will take into account, or can be solved using the NPV formula, but there is a trick that is unique to Excel. So let's go back and look at a situation here where we have an investment of $800, and we're showing that as a negative amount as an outflow. And we have an uneven cash flow. The net present value will be calculated using our NPV. Again, we have to use a discount rate of our choosing. In this case, we chose 10%. And now our values must begin with the period 1. We cannot use the initial investment. So again, we'll highlight our cells for years 1 through 5. Click OK. That returns our present value of the cash inflows. To make this a true NPV, we have to take one more step. We have to go up to the formula bar and say include with that, and since we have put it in as a negative amount, we're going to put the add in. We're going to add in the investment. And when we do that, we have factored in our investment, and our net present value is $33.97. And what that tells us is that this investment will return an amount greater than our required rate of return of 10%. So this is our required rate of return, and you'll be using this calculation frequently in capital budgeting decisions, in finance, for choosing investment alternatives. So it's something you're going to come back to, and again, understanding this little trickery that you have to do in Excel is important, since Excel does not include a initial cash outlay when calculating NPV. Now, you don't have to master all of these right now. We will be using an intermediate, determining the payment amount. For installment loans, we'll be looking at the calculation of annual interest rates when we look at leases, and we will be using quite frequently the present value of varying cash flows. So keep this video in mind. If you need to come back and refresh it, hopefully it will help you out. Thank you.